Good morning and welcome to Digital Look TV. With us today is Bill Hubard to discuss the current market situation and the implications of recent events in capital markets worldwide. Bill, good morning.
Good morning.
Thank you very much for joining us. Okay, let's see. I'm going to work my way a bit backwards. You sent me a note a couple of weeks ago warning of the possibility of weakness in equity markets. The current situation reminded you a little bit of the setup that we had seen even, say, a decade ago. Are you still of that opinion? Are there risks out there?
Well, I think there are risks out there. I think one of the things we've seen is that I would see that the risk quote are over in the equity markets. Okay, and one of the things I think that's helped it has been first, the May FOMC minutes and then the June FOMC minutes with the press conference, and what we saw, I guess, looking at the data of the month ending the 27th of June, there was 79.8 billion, in bond funds that were liquidated, going back into cash. All right.
Right.
So then, if you believe that the Federal Reserve was going to start tapering, and if you believe that interest rates were going to go up, and we've seen since that time, we've seen the Treasury 10-year go from about 210 to about 275.
Yes.
So what we've seen is we've had, at least in the States alone, we've had almost 80 billion in cash reserves. Okay, that went in. Of course, they didn't go in before the 30th of June because of the simple fact that was the end of the quarter, the end of the fiscal year. And then, of course, last week, a distorted week because of the
4th of July
holiday and non-farm payrolls.
Okay. The situation, to me, but I don't have your experience, reminds me a little bit of in 2000, you had a much more severe drop, true. And then the NASDAQ seemed to stabilize during the summer, even recover a bit, and then in September, it started to fall again. Might we be looking at a similar setup right now?
I don't think so, because I think one of the things that we have to look at, and all I can tell you is, if you want to ask me a question about Bernanke last night, the answer is confused.com. What we have seen is the simple fact is that the Federal Reserve will not begin tapering or reducing their purchases, okay? And so therefore, with what we saw last week, which was explicit information both from Mark Sterling Concarney, the new Bank of England governor, and even Mr. Draghi, who was clear, fully understood. The simple fact is interest rates are going to be lower for longer, and the same thing will be occurring in the United States. So there is no concern at all in any way, shape, or form that we'll see an interest rate hike, either from the U.S., the UK, or the Eurozone, probably before mid, and I'm talking probably to very late, and probably here in the UK and in the Eurozone, probably not till early 2015.
Okay, I see. Okay, going back to the subject of the FOMC, I've seen some analysts talk of confused.com.
Yes.
Others say flip-flopping Bernanke.
I think the difficult thing is that it goes back, and we were talking about this earlier, twice a year the Federal Reserve has to go before the U.S. Congress to justify their position, okay? And this goes back probably 10, 12 years ago when Greenspan was chairman, and one of the senators asked him a question. And Mr. Greenspan's response was, well, if you understood the question, then you must not have been listening, okay? And so therefore, I think what we probably have here is the simple fact is that I think Bernanke has not communicated as well as he should. And I think what we saw yesterday in the FOMC minutes, we still had, half the FOMC saying, well, again, we need an improvement in the labor market. Inflation is not a problem. And one of the things, yesterday's speech by Mr. Bernanke was for the 100th anniversary of the Federal Reserve. Okay. And the Federal Reserve basically, their whole remit was non-inflationary growth. Well, it worked for the first 99 and a half years, and it was only until last December when Mr. Bernanke put a number on growth, the unemployment huge number, and also inflation. Well, it originally was we want unemployment to get down to 6.5%, and then it was sort of hedged up to 7 and maybe more. Well, as we've seen, inflation is not a problem. And to go back even further, Janet Yellen, who is co-chairperson, number 2 at the Fed, and when I don't expect Mr. Bernanke to roll over his next commitment, which expires on the 31st of January next year. Now, she was attended a meeting as head of the San Francisco Fed in 1996, okay? And one of the points that she mentioned was the relationship between inflation and employment or unemployment. One of the things why she's pretty good at this is her husband, who teaches at the University of California, actually won the Nobel Prize in economics in 2001. And the point of his whole thesis was the unemployment rate and inflation. And it was basically, if inflation is too low, okay, the unemployment rate will be too high. Because the simple fact is, why hire people and have to pay them an exorbitant salary when I can do temporary workers, et cetera, et cetera. So now maybe what we've seen, and maybe this was a real clarification, because Janet Yellen really extolled this in a meeting, I think it was September 1996, when Mr. Bernanke was a young gentleman there, okay? So I think it's been a question that the unemployment rate's not coming down. Also, again, without getting too technical, the U6, which is really what the Fed looks at, okay, that actually increased from 13.8 to 14.3. So the simple fact is, as we saw 2 months ago, the rate went from 7.5 to 7.6 because 400,000 new people said, hey, things are improving, I'll come back into the workforce. So now this is the concern, will it start to come back in? And my feeling is that the Fed, I would be quite surprised now if they start doing any tapering, okay, this year. Interest rates have backed up. So with the Federal Reserve, either we weren't listening, okay, or misinterpreted. And yesterday's minute shows there is a real discrepancy. And I think that's one of the things that people have to understand, okay, is that the Federal Reserve is 13 districts, okay? So each meeting, well, Detroit may be okay, but San Francisco's not. New York may be booming, but Seattle is not. And so you still have that dichotomy. And also you've got to look at Detroit, which used to be the hub of the automobile industry. You know, you want to buy a city, you know.
Okay, fair enough. The U6, that's interesting. I've had some analysts send me reports about the U6, some commentary. But I believe it was towards 1995, the U6 unemployment rate was around 10%. Back in those days, I was in Boston, and there was no unemployment. You had help wanted signs everywhere. So for people here in the UK, really, how much unemployment is there really in the United States?
Well, I think it's like anywhere else, okay? You've got the official rate, the unofficial rate, and then, of course, you've got the black market. And I think one of the things, and I've seen this, especially here in the UK in the last 3, 4, 5 years, I think they're called like breakfast industries, okay? It's like senior people laid off by IT companies or banks or this and the other. So 3 or 4 guys get together and they'll start a mini company. Well, are they unemployed or are they not? They're probably not unemployed, but they're not, in the numbers. And also the simple fact is, although I've been away from the States now for more than 25 years, when I left 25 years ago, there was no such thing as a temporary agency. You either hired or not hired. And one of the things that where the U.S. is far more fluid, because it doesn't have, employment laws like we do over here, right? Well, you hire somebody over here. Well, if you want to get rid of them, you've got to go through an exorbitant amount of this, that, or the other. So what you see in this type of market, you won't have people hiring in the UK or in the Eurozone, okay? Where you may have people doing marginal hiring, but I think this key thing is the Janet Yellen's husband concept about if inflation is too low, you're not going to hire somebody. So it'd be quite interesting to see if inflation did start getting 3, 4, 5%, would we start seeing a dramatic decline in the unemployment rate?
Interesting. Okay. Let's see, oil prices. They've been backing up of late.
Yes.
It's seasonal factors, but also part to do with Egypt.
Yes.
What's the worst scenario there?
Well, I think the concern is what happens if they do close the Suez Canal. And what you're seeing is it's not so much the spot market, but look where you're seeing 3, 6, 9 months out. Okay, that's where you're seeing the real discrepancy. You're also seeing the discrepancy between WTI and Brent. Okay, but one of the things, and we saw yesterday from OPEC announcing that yes, there will be increased demand in 2014, but less demand from OPEC. And they specifically said mainly because of new oil drilling techniques in both the U.S. and Canada. And I mean already, with the fracking and this, that, and the other, with oil prices and also natural gas. I mean, a number of the pundits in the U.S. are already calling Saudi America. And I mean, for the first time since John Wayne was a teenager almost, the U.S. now is becoming almost self-sufficient.
Fantastic.
In oil.
So you don't see it as a big risk to watch out for?
No, I don't think so. I mean, it's going to be as quickly as it came on, it will disappear. Also, one of the things that we've seen is a dramatic drop, and that's what really spurred it on in the last 2 weeks. Both the API and the Department of Energy, a massive drop in supplies, especially in the States, with this being what they call the driving season.
Okay. Backtracking a little bit to the issue of inflation, where it's going, where it's headed. Gold prices. Some commentary is highlighting the backwardation.
Yeah.
Is that pointing towards deflation?
Well, I think one of the things, again, we've talked about, gold being a traditional non-interest-bearing currency and also being an inflation hedge. Well, there has been no inflation hedge. So really it's a question of, we reached a point, just a couple of years ago, we were 1900. Now, we got down to like 1200, and then this week 1245 was a technical support level. Now, I haven't seen it this morning, but I figured if the dollar is being hammered, gold probably could be in the 12 and a half, 1275 level. And also another thing to look at is, what will happen now, because all you got to do is look 2-3 years ago. Every pawn shop is buying gold. Every pawn shop is buying silver. I mean, where we live in Wiltshire, I mean, they were stealing railroad.
The tracks.
The tracks. Anything that was, a metal. Now, one of the things to look at is, with China slowing down, this is having a negative effect, of course, on the Aussie dollar and the Australian stock market. So, I mean, slowing down is 7.5 to 7,
Not bad.
I wish we could slow down. We won't be 7.5, 4 or 5 years combined. So what you're seeing right now is the super cycle is over, mainly because it was easy money. And I mean, what you'll have to do is, especially that's getting hammered, are the mining stocks. Okay, no matter if gold's gone up the last 2 or 3 days, but the mining stocks are still not gone because the spread's not there. So what you're having to look at is a shift away from the easy money for 8, 10, 12 years of buying gold. I'm still positive on gold, but I can't see it going back to $1,400-$1,500 an ounce anytime soon.
Can I get your thoughts, please, on the upcoming IPO privatization of Royal Mail? Do you have any thoughts on that?
I mean, I just remember when they did it with BT and stuff like that. I mean, I think it's 25 years too late.
Okay.
I think it's a situation where I think TNT, they already have 1,000 postmen out. In the next 5 years, they want to have 20,000.
I see.
They are being paid for proficiency. We did the same thing in the States 30, 40 years ago. It just doesn't work, okay? And I think one of the things that we have to look at is what's killed the post office, okay? Facebook, Twitter, email.com. I mean, how many people send Christmas cards? Right. I mean, all you got to do is look on the high street, Clinton cards. Nobody sends birthday cards. Nobody sends Christmas cards. You send a tweet message and this, that, and the other. And I mean, you see this, okay? I mean, look at the price of stamps that have gone up. And so therefore, you're even talking about, I think one of the major reasons they're doing this is, I think Deutsche Post was looking to buy the Royal Mail, okay?
Probably.
And so, I don't, maybe I'm wrong, I wouldn't touch it with a 10-foot pole, okay? I mean, it's sort of like, you want to buy some Lloyd's Bank bonds, yes?
Not anymore. Okay, fantastic, Bill. Thank you very much.
My pleasure.
Bill.
Thank you.
And thank you for joining us again at Digital Look TV. Until next week.